Another one of our, these is one of our industrial buildings. Look at the capital management, loan to value ratios, and interest cover ratios. The loan to value ratio in the South African business sitting at 27.4%. So you can see, pretty conservatively geared balance sheet and very well within all of our covenants. I think our banking covenants are at about 55% loan to value. We know that the ratings agency, Moody's, who performs annual rating, obviously like to keep an eye on this ratio in particular. I think 40-odd% is a critical number for them, so we're well within that number as well. Our interest cover ratio in South Africa is sitting at 3.5 times. So you'll see a little increase in our gearing from 23.9 to 27.4. And I think the only comment there is that the 23.9 last year was obviously low. I wouldn't say artificially low, but it was low due to the fact that we had the very significant capital raise of $2.5 billion in May 13. So that capital was in and on the balance sheet through the, we used as much as we could to reduce debt, and the balance we held in cash. So the June 13 LTV numbers were particularly low because of that big capital raise. Subsequent, and obviously now at 30 June 14, we have spent that money. We've invested it into the Tiber and AppSec portfolios, and net of all the equity we raised during the year, we're sitting with 27.4%. Australia's sitting at 40.6%, and it is, again, I think, a tribute to Australian management there as to how they've managed that balance sheet. If you go back to 2011, which is probably just not on this slide, we were at 50% loan to value in Australia. So systematically, as we've added properties to the portfolio and diversified that portfolio and grown it, we have funded it with a slightly greater proportion of equity than debt. We haven't had a massive amount of re-rating of the property portfolio, or let's call it revaluation of the property portfolio in Australia. So that isn't the key driver of the reduction in LTV. It was mainly, adding more equity into the mix on the acquisitions. So from a group perspective, we're looking at about 30.8% loan to value ratio and 3.3 times interest cover. South African access to debt remains pretty healthy, and over the years we've tried to diversify the sources of borrowings. We have 8.9 billion in the form of secured bank debt, 1.45 billion in the form of secured debt provided by institutional financier. We have unsecured bank debt to the tune of about 1.8 billion. We got 3.9 billion rand worth of corporate bonds in issue, and then our commercial paper at 400 million, making up the total of 26%, therefore, of the total debt in the debt capital markets, and 74% of our total debt in the form of traditional bank debt. 16.5 billion on the SA balance sheet. It remains a strategy of ours to look at all sources of debt funding, obviously to drive down the cost of our debt funding as best as we can. And we do target over the longer term to bring the mix between traditional bank debt and debt in the capital markets to a ratio of about 50-50, and we hope to achieve that over time. On the capital management side, we did raise in aggregate through the DRIP issue, through the issue of equity as part of the purchase consideration for some of the acquisitions. In total, about 9.1 billion rand worth of additional equity during the year, and we took on about another 3.9 billion rand worth of additional debt. We also bought back some shares during the year as part of refinancing some of our empowerment transactions that we did in 2005 and 2006. Two of our partners one elected to exit completely, the other one elected to just settle all the borrowings that they had in the structure that we had with them. And as a consequence, Growthpoint's bought back about 33 odd million shares which currently are sitting on our balance sheet as effectively sort of treasury stock and are a natural hedge for us for any obligations that we've got in terms of the share schemes that the company runs. If you look at some of the key metrics or KPIs that we manage on the debt side, we have 3.8 billion rands worth of unutilized but committed facilities at balance sheet date. The weighted average term of our debt is 3.5 years. The weighted average term of our fixed interest rate profile, obviously we hedge all of our, or the big chunk of our interest exposure. The weighted average there is 4.3 years. Our weighted average interest rate is 9.4%. The percentage debt that has been fixed is 78%, so approximately 22% of our debt is subject to floating interest rates. We have 32.8 billion rands worth of unsecured or unencumbered assets on the balance sheet, and of the total debt that we've got, 6.1 billion is in the form of unsecured debt. We have about 12.9 billion rand invested in marketable securities, Growthpoint Australia being a big chunk of that, and then AccuCap and SciComm obviously being about 4.5 billion. And that is available for use in an unlikely event of liquidity, or an unlikely liquidity event. I know, again, this is important for the ratings agencies. Moody's did maintain our credit rating recently, but they did give us a change in the outlook, which was positive, from stable to positive. So we're very pleased with that. And then on the treasury policy, we continue to conservatively manage the balance sheet. We have a policy that whereby we ensure that cash flows from operations plus the available credit facilities will exceed all committed cash outflows and debt maturities over a rolling 12-month period. It's a constant challenge for our treasurer, Dirk, here sitting in the audience here, to ensure that the future expiries of debt or bonds or debt facilities are covered and renewed in time, to ensure that we don't run a liquidity crisis when perhaps one of those facilities we're unable to roll. And then we all maintain our policy of having fixed interest rates, whereby the minimum ratios of fixed interest rate obligations to debt is that 75% for 12 months need to be fixed, 24 months 65%, and 50% for 36 months.